Good afternoon. We are at the Business Franchise and Investment Expo. I'm here with Perry Maisonneuve again. Perry, thanks for answering all of our questions. Perry is with Northern Lights Consulting. Perry, we just discussed a little bit about some of the different routes of getting into a business. Sort of in correlation to that, the financing. Now, does the financing differ, I guess, if you're starting up your own business or franchising? Do they provide financing for you? Is it something that you have to do all by yourself? How does that work exactly?
That's great.
Two different routes, I guess.
Yeah. Financing is an interesting topic, and quite frankly, for those of us that are fortunate enough to have lots of money, we don't necessarily want to use all the money we have. So financing is often something that's almost every single time, whether you need it or not, you tend to do it. So you need to understand what the banks are looking for and what their triggers are, as well as how they're going to apply those policies and procedures to different business proposals that are presented to them. The first, of course, is if you're going to try and start a business of your own. First and foremost, we are fortunate enough in Canada to have something called a small business loan that's actually guaranteed by the federal government. So if you borrow $100,000, 75% of that, or $75,000, is guaranteed by the Bank of Canada. So God forbid something happens, you're on the hook personally for only $25,000 rather than $75,000.
That's great.
So that's fantastic, and everybody uses it. It tends to be applied to each specific business. It's applied to basically what are referred to as collateral assets, tables and chairs, carpet, paint, equipment, that kind of something you can touch and feel. It can actually go up to $500,000 for real estate. If you're actually buying an investment property, for example, then you can apply for a small business loan on up to $500,000 for real estate. Otherwise, $350,000 is a good number. So if you think about that, that covers a large majority of the businesses that are out there. Mm-hmm. Now, the next step is that even though the federal government provides that, the federal government requires the individual banks to apply their own credit adjudication or credit policy to every loan application. So there's got to be a business plan in place. They look at the risk of the industry, and they apply what's called a debt-equity ratio. So what does that mean? The equity is the money that you're going to put in, and it's got to be unencumbered, which means it's free cash, not borrowed cash. And there's a matching of the amount of debt to the amount of equity that's put in. So let me give you an example of that. In the food service business, because the rate of failure amongst restaurants is so high, the banks require $1 of your own money for every dollar of debt that they put up. So it's what's called a 1-to-1 debt-equity ratio. Okay. If you go into a service-based business, such as Oxford Learning, or some of the other service-based businesses down there, they'll go up to $2 of debt for $1 of equity. Why? Because service-based businesses, there's a lower capitalization, less bricks and mortar, lower break-even points, and so statistically the banks know that there's a lower incidence of failure, so they're prepared to go to a little bit more higher leverage being the amount of debt to the amount of equity. So that depends. It depends on the industries, so you need to know that in a discussion with your commercial lender. He'll walk you through that kind of thing. The other issue is risk is being applied to starting up a business on your own, because they know the failure rate of independent businesses, versus, let's say, buying an existing business where that existing business had a banking relationship with RBC or TD or BMO. And so there's a track record of the profitability of that business. So they'll provide a certain debt. Sometimes they'll go up as much as 60-65% debt to whatever the equity is. They still want that equity. Very few organizations institutions will lend 100% debt. And then, of course, the third is the franchising. And in franchising, all the major banks, the 5 major banks that we have in Canada, all of them have a franchise banking group. So a department at head office that specializes in financing franchised businesses.
Oh, okay.
Okay, so they have a relationship with the franchisor. They're all members of the Canadian Franchise Association. So they all know each other, and relationships are built. So some will develop a formal lending program that, for example, RBC will send out to 1,200 commercial lending officers across the country, so that if a franchisee walks in Kitimat The loans manager can go to a shelf, pull off a little portfolio, and boom, it's all laid out.
Wow.
So it just facilitates the whole
like that,
process,
yeah.
just nice and smooth. And then there's others, what are called tier 3, tier 4 tiers. Some of the banks call it an ABC system, some call it a 1, 2, 3 system. There's a ranking system in terms of the maturity of a given franchise system and the risk associated with that. So for what we call in my practice, we call it the farm team, the up-and-coming systems. It's an informal process where the franchisor will communicate with head office. I'll say to Ginny Frank at RBC, hey Ginny, we've got somebody in Kitimat. Can you introduce us to your local franchise champion? And she'll say, yeah, sure, Perry, they're a client of yours. We know your work. Sure,
Yeah,
your
yeah.
client's good. So it's very much reputation too. But either way, everyone's in the business of business. It works for everybody's sake to help grow and create jobs and all that kind of stuff. So the banks are there. So that's a franchise system. And then, of course, we talked about buying an existing business where there's an existing situation, and we talked about startups, which is the highest risk, and therefore the most difficult to provide financing for. So that's often that case. You might have equity, you might have some cash, but you just can't get it together because the banks will perceive it as too high risk to bank it.
Perfect. Thank you very much.
You're welcome, Mike.